How does the casino make consistent money on an event that's completely random? The casino has a lot of similarity with trading, and in this video I'm going to bring the trading system and the system the casino use in their day-to-day business and see the similarities and how we as traders can implement some of the system proven by the casino to be profitable. So what are these advantages that makes a casino profitable in the long run? Let's dive in and look at a few of them. So we have the house edge. So what does this consist? What makes the house have the edge against the players? So we have the probability in favor of the house in terms of the house winning and in terms of the house losing. So if you check the probability of the player winning and the player losing, you will see the player losing has a higher probability, which tricks the edge in favor of the house. And we have also the casino focus on the long-term outcome of their edge. They don't try to focus on short-term outcome, because the short term, the casino might be losing on the short term, but once they give their edge a room and a lot of time to play out, it's going to play out perfectly. So the main focus of the casino is to keep the players long enough for their edge to play out in their favor. So they are there. That's why casino is designed in a way to entice the player, to make them lose track of time so they can stay and bet for a long time to make the edge in favor of the house. So let me give you guys an example of this. Imagine the player having a 47% chance of winning a bet and the house having a 53% chance of winning. In the short term, the results are random, so the player can have a 2 winning streak. But if the casino keeps the player there for a long time in a huge sample size of bets, they are sure to have the edge in their favor. So how can the trader implement this to their trading system? They should have in their mindset that short-term results are random. Their strategy might lose money in the short term, but if they have huge sample size of trades, if they try to track their trades, say they give their strategy room of, say, after 100 trades I check and see if I'm profitable. That's the same strategy this casino use. They focus on the long term. They are not interested in the short term, because they know in the short term they don't have the edge. They have the edge in the long term. That's why they are designed to keep players from betting for a long time, so their edge can play out. So we can take this system from the casino and apply to our own trading system by focusing on the long term and not trying to make huge short-term wins. So as traders, we should ask ourselves, are we focused on the short term or are we focused on long-term profitability? So the next advantage the casino has is they keep their risks consistent. This is very important. Keeping your risks consistent can be overstated. It's very important to keep your risk consistent, because if you have an inconsistent risk, it's going to mess your whole system and gives your edge the negative probability in the long run. Imagine the casino risking the $1 per trade per individual bet, and they decide to, maybe the manager decides to increase the bet to $2 because he has the belief that the next player is going to lose or something. And imagine that player now winning, having a winning streak. That messes the edge the casino has in the long term. It's going to make sure that they lose that edge they have over the long term. So keeping your risks consistent is very important. As traders, we should focus on keeping our risks consistent on a huge sample size of trades. We shouldn't be focused on increasing our risks on individual trades based on the emotional belief or feelings we have towards that trade. In the short term, remember guys, in the short term, trades are random. The outcome of each trades are random, but in the long term, probability plays in our favor if we keep our risks consistent. And the next thing here is they put a cap on their max loss. So this is a very important strategy, putting a max loss. They have in their rules, the casino have in their rules that they are not, let's say for example, they are not to pay out more than $2,000 on a particular table on a particular bet. they've already done their back end calculation, and they realize that if they are to pay above 2000, no matter the edge they have, it's going to turn out against them over the long run. So they, after doing their sophisticated calculation, they've realized that maybe keeping their risks below 2000 and they allow probability to play in their favor, in the long term the edge will be in their direction. So as traders, we should focus on having a max loss. We shouldn't be looking at making huge risk just to hope that we come out with huge profits. We should try to put a max loss on each trade we take, which will help us in the long run. And the next important step and the next important advantage they have here is they avoid changing their rules and risks for any reason, which is the emotional control. This is a very important strategy because without emotional control, you are not going to have a good risk management system which will give you the negative edge over the long term. So what the casino does here is they don't allow any emotional decision in their system or in their rules. The manager doesn't play any individual emotional decision on every bet or on every player. He doesn't look at a player and judge the outcome. He lets probability play and he follows his system and his strategies. So it's important to know that inconsistent risks can destroy their whole strategy and advantage they have over the individual player. So this is just a summary of how the casino strategy is. They have the edge plus the risk management to put a cap on their max loss and to keep their risks consistent, plus their emotional control to manage their risks and their edge, which will result to a profitable system. The casino keeps their risks consistent even during a short-term losing streak. They don't decide to increase their payout risks just so they can also increase the possible reward to complement for their previous losing transaction. They don't change their system for any reason. So this is a simple game of American roulette, and the rules here is there are 36 numbers here and a total of 38 spaces. So we have 18 red space and we have 18 black spaces, and the probability for coming out a red space is 47.4%, and the probability of black space coming up is 47.4%, and the two green spaces, they have a probability of 5.26%. So betting on one of the main colors, that's either black or red, this is an even money bet, which is you risk $1 to have a reward of $1. If we implement this in our trading system, risking $1 for a reward of $1 in a system that has a probability of 47.4%, we can already see in the long term we won't be profitable, which is what the casino has. The casino has a probability of 52.6% over the player. That's the casino has probability of winning 52.6%, while the probability of the player winning is 47.4%. This 52.6% tweaks the favor on the long term to the casino, which means if they continue risking $1 and getting a $1 reward over the long term, which they have 52.6% chance of coming out profitable, they will come out profitable over the player, which is very simple to understand. Imagine now the casino increasing their reward while keeping the risks constant. They say the player can risk $1 now to make $2, and with the player just having 47.8% chance, if they get to increase their reward for the player, which is their payout, on the long term they will not be profitable, which is why it's very important for them to keep their risks constant and to have a max loss and a max payout day on any particular bet. So what we should take away from this whole video is the summary of the whole thing is the casino has 3 advantages which makes them profitable over the long term, which are they have an edge which puts the probability in their favor, and they have a risk management system which makes them put a cap on their max loss and makes them keep a consistent risk. And they also have an emotional control, which gives them the ability of not letting emotional decision making hinder their long-term profitability. So I hope you guys learned something from this video, and I wish you guys a successful trading career. Peace.